Something about this Bitcoin bull run just feels off. No explosive hype, no endless headlines about overnight millionaires, and yet, prices keep grinding higher, almost like a slow motion rally nobody really believes. If you've been watching the market lately and wondering why it doesn't look, or frankly feel like the last cycles, you're definitely not alone. For more than a decade, Bitcoin followed a rhythm everyone came to expect. The halving cuts supply, demand explodes, prices melt up in an absolute frenzy, and eventually, the whole thing comes crashing down. But this time, the old playbook just isn't working. My name is Danielo, and today I'm breaking down exactly why this cycle looks so different, what's driving the massive shifts under the surface, and what it could mean for your own strategy going forward. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. For more than a decade, Bitcoin moved to a rhythm that almost everyone came to rely on. It was so consistent that traders started calling it the quote 4-year cycle. Every 4 years, the Bitcoin network cuts the supply of new coins in half in an event called the halving. This built-in scarcity shock usually sets off a predictable chain reaction. Supply drops, demand stays steady or even increases, and prices surge as investors scramble to front-run the next big rally. You probably remember how this played out in the past. In 2017, Bitcoin ran from around $1,000 all the way up to $20,000 in less than 12 months. Then, in 2020, after the next halving, it did something similar, climbing from around 3,000 to nearly 70,000 in about a year and a half. Every single time, the pattern looked the same. First, a quiet accumulation phase, then a steep parabolic run, then the euphoric blow off top as media coverage exploded and retail investors piled in. And finally, the inevitable crash that wiped out most of the gains. This is the playbook that almost every crypto investor, trader, and influencer has had burned into their brain. It's the reason so many people assume that after the 2024 halving, history would repeat once again. But if you look at what's happening right now, it's clear the pattern isn't behaving the way it used to. And if you keep expecting the same script, you could get blindsided. If you zoom out even further, this 4-year cycle mindset didn't just shape price predictions, it shaped the entire culture of crypto itself. Exchanges, influencers, and even institutional reports have treated the halving as the most important single event in the market, almost like a natural law that couldn't be broken. It became kind of a collective belief system that Bitcoin's scarcity shock was so powerful it would override everything else: regulation, macroeconomics, or even who was buying. But lately, that belief has been colliding with a reality that looks nothing like the past. For the first time in Bitcoin's history, the most powerful force in the market isn't retail traders or crypto native whales, it's institutions. Over just the past year, the scale of buying by asset managers, ETFs, and corporate treasuries has completely changed the landscape. Since launching in January 2024, US spot Bitcoin ETFs have grown to hold over 6% of the entire circulating supply, totaling more than $135 billion in assets under management. The largest single fund, BlackRock's iShares Bitcoin Trust, alone controls nearly 700,000 Bitcoin. This flood of institutional demand has been like a giant vacuum cleaner sucking supply off of exchanges and into long-term custody. Unlike retail traders, these buyers don't panic sell on every single dip or chase every pump. They file paperwork, they allocate methodically, and they hold for years. That creates a slow but steady upward pressure on price, even when sentiment does feel lukewarm. You can see it in the data. Since these ETFs went live, Bitcoin's realized volatility has collapsed to some of the lowest levels in its entire trading history. And it's not just ETFs. Companies like MicroStrategy have become almost synonymous with institutional Bitcoin accumulation. As of this recording, MicroStrategy holds around 600,000 Bitcoin, more than 3% of the total supply. Even the US government is in the game. Earlier this year, the Treasury announced plans for a strategic Bitcoin reserve, built from seized coins and newly acquired holdings, positioning Bitcoin as a kind of sovereign digital asset alongside gold. When you step back and look at how much Bitcoin is being locked away by the institutions, it starts to make sense why this market feels so different. Almost like the old cycles are being replaced by something quieter, but just as powerful. One of the strangest things about this cycle is how calm it feels compared to the past. In earlier bull runs, Bitcoin's price action was like a roller coaster. Huge pumps and sudden crashes were almost a daily occurrence. Today, that same energy has vanished. Since the launch of spot ETFs, Bitcoin's realized volatility has dropped to some of the lowest levels on record, hovering under 50% for weeks at a time. One big reason for this change is that Bitcoin isn't acting like an isolated speculative asset anymore. Recent data showed that its correlation with the Nasdaq and the S&P 500 climbed as high as 0.87 earlier this summer. That means Bitcoin is trading almost in lockstep with traditional risk assets, and it's absorbing these same macro signals: interest rates, inflation expectations, and institutional flows. Instead of a purely retail driven mania, it's starting to behave more like a global macro instrument. For traders who built their strategies around explosive price swings and sudden reversals, this shift can feel almost disorienting. But if you understand why volatility has collapsed, it also explains why timing this market with the old tools just doesn't work anymore. While institutions have been steadily buying Bitcoin behind the scenes, retail traders haven't been following the same script as before. In previous cycles, the rally started with Bitcoin and quickly spilled over into Ethereum and the rest of the large cap altcoins. Eventually, as euphoria peaked, money would flow into riskier tokens and meme projects, but this time, that entire rotation has been flipped upside down. Ethereum has lagged Bitcoin by a wide margin, with the ETH to Bitcoin ratio dropping to levels not seen in almost 5 years. Part of the reason is that most of Ethereum's activity has shifted to layer 2 networks like Arbitrum and Optimism, which handle the bulk of transactions and drain volume and fees away from the main chain. Without a strong catalyst, ETH hasn't captured the same attention or momentum it did in past cycles. Meanwhile, the speculative energy that used to flow into the large cap altcoins has been redirected into a completely different part of the market: meme coins on Solana. Over the past few months, more than half of all Solana DEX volume has come from meme tokens, with traders piling in to try to catch the next 100-fold move. And it's not just the retail punting memes on decentralized exchanges. This week, the first Solana staking ETF went live in the US, attracting tens of millions of dollars on its first day. That's a sign that even institutional capital is starting to diversify beyond Bitcoin into higher risk assets with yield potential. If it feels like the old patterns of rotation and narrative momentum have broken down, you're not imagining it. Retail speculation and institutional flows are now moving on completely different rails, and it's creating a market that looks nothing like the last cycle. One of the biggest reasons this market feels so different is that regulation isn't the constant source of fear it used to be. In past cycles, any big rally was eventually met with a wave of crackdowns, whether it was China banning exchanges, the SEC targeting ICOs, or regulators threatening to shut down stablecoins. For years, regulatory uncertainty hung over the entire industry, and it kept a lot of institutions on the sidelines. That picture has shifted almost overnight. Earlier this year, the US Treasury announced plans for a strategic Bitcoin reserve, effectively signaling that Bitcoin is being treated as a legitimate sovereign asset. At the same time, the SEC has started backing off aggressive enforcement, and regulators have laid out a clear framework for stablecoins to operate legally. These changes don't just reduce existential risk, they also open the door for large pools of capital that were waiting for regulatory clarity. Pension funds, endowments, and sovereign wealth funds now have a credible path to participate without worrying they'll be caught in a sudden policy reversal. Even with all this buying, you've probably noticed that Bitcoin hasn't gone vertical the way it did in past bull runs. Part of the reason is that a lot of the ETF flows everyone talks about aren't actually new money coming in. They're in-kind transfers. That means large holders and institutional custodians are moving existing Bitcoin into ETF structures without creating fresh demand on the open market. It's a little like reshuffling the furniture rather than bringing in the whole new shipment. At the same time, there's been a steady stream of long-term holders finally taking profits. Some of these coins have been sitting dormant since the last cycle or even longer, and with prices testing all-time highs, it's quite natural that early investors are looking to lock in their gains. This creates a slow but persistent selling pressure that absorbs part of the new institutional demand and keeps price appreciation more measured. Analysts like Tom Lee have called this the quote churn phase, where old supply gradually meets new demand. It's not exciting to watch, and it doesn't generate the same kind of headlines as a sudden breakout, but it's a sign of a maturing market where liquidity is deeper and price discovery is more stable over time. So where does all this lead? If you look at how the market has evolved, there are really two possible futures that could play out over the next year. The first is a slow institutional grind higher. In this scenario, ETFs and corporate treasuries keep dollar cost averaging into Bitcoin, gradually pushing the price up without much volatility. Retail interest stays muted, and the old parabolic blow-off tops never really materialize. Instead, Bitcoin behaves more like a strategic asset, somewhere between gold and tech stocks, where steady inflows eventually create a new all-time high, but without the frenzy that usually comes with it. The second future is a delayed retail FOMO wave. Maybe it takes a big catalyst, like a major policy change, a macro shift in interest rates, or a breakout to a round number like 200,000. If that happens, retail traders could rush back in, and the calm accumulation phase could flip into a fast, volatile melt-up. It wouldn't look exactly like 2017 or 2021, but it would bring back some of the explosive energy that defined those cycles. Whichever scenario you think is more likely, the key is recognizing that this market isn't behaving the way it used to. The patterns have changed, the players have changed, and the pace has changed. And being prepared for both possibilities is what separates people who get caught off guard from people who stay ahead of the curve. If there's one thing to take away from all of this, it's that the old rules aren't as reliable as they used to be. The 4-year cycle isn't gone, but it's competing with new forces, institutions locking away supply, regulators providing clear guardrails, and retail speculation moving into different parts of the market. That means if you're still using the same playbook you used in 2017 or 2021, you're probably going to feel out of sync. This cycle is quieter, slower, and more professional than anything crypto has seen before. That can be frustrating if you're waiting for the same kind of fireworks, but it also creates opportunities for people who are patient and willing to understand how this market is evolving. The most important thing is to stay clear-headed. Don't let the lack of volatility convince you nothing is happening, and don't assume that just because price isn't exploding overnight that the story is over. It's not. It's just different this time, and being able to adapt is what gives you an edge when everyone else is still chasing the old patterns. If you've made it this far, you can see why this Bitcoin bull run doesn't look or feel like any of the others. The entire structure of the market has evolved, with institutions steadily accumulating, volatility collapsing, and retail speculation moving into different corners of the ecosystem. The old 4-year cycle isn't gone, but it's no longer the only force that matters. This is a market in transition, shaped by methodical buying and a new set of incentives. Expecting the same script as last time could leave you unprepared. What do you think happens next? Does Bitcoin keep climbing in a slow, steady march, or is there still one last wave of explosive volatility waiting to play out? Let me know your thoughts down in the comments. If you found this video helpful, make sure to subscribe and hit the notification bell so you never miss future crypto updates. Thanks for watching, and I'll see you in the next one.